Oh man, so the market had a bit of a yo-yo day yesterday, and the Fed are trying to destroy Bitcoin here with their interest rate policies. What's going on? Are we going to see an emergency rate hike? All this FUD around the inflation being the highest we've seen in 40 years. We're going to break all that down. I'm going to show you what I'm seeing in the Bitcoin chart, and then we're really going to get into the bottom of this, of what's actually going on. So if you like this type of video, make sure you hit the like button and subscribe. If you want to support NordVPN, check out the link in the description. Get yourself set up on a VPN, guys. They've been kind enough to offer this community 70% off a 2-year plan. That's 24 months plus a month they throw in for extra for about $2-3 a month, guys. So you can't go wrong. Make sure you're staying safe in crypto. Make sure you're anonymous when surfing the web. You can choose which country you're paying from. Whenever I log into Exchange, whenever I'm using my wallets, I'm always making sure I'm doing that via VPN. So make sure you're taking the time to stay safe in crypto. Let's head straight into the charts, because we had a bit of a crazy day yesterday. So you guys remember, this is the big candle when inflation came out. That's your big hourly candle here. When the news came out, highest inflation we've seen for 40 years in the US. Big candlestick to the downside. This was your short-term sellers. And again, if you've not watched my Bitcoin video from yesterday, go find my video yesterday where I explain whether Bitcoin is seen as an inflation hedge or not. Because there's a bit of a nuance here. And you need to take the time to watch that video, because you're getting these two camps, which is, yes, it's an inflation hedge, and no, it follows the NASDAQ. And the answer is, there's a bit of nuance there. So go watch that video for the real explanation of how it acts. And then we saw this dip getting bought. Okay, this dip got bought. So we saw some weak hands sell some Bitcoin, and the dip was bought. And there's completely two different types of investors selling and buying Bitcoin here. Again, I explained that in that video. And then we ran to a high. We ran to a high here. We wicked as far as 45,800, which is some great strength here, given that we just got news about the highest inflation we've seen in 40 years. And then we fell again. What was this? So you can imagine, started the day really red, turned nice and green with a new high. Okay, and then boom, all the way down, wicking down to 42,673 roughly. Okay, 42,600, let's call it. Yeah, so that's a massive swing in a day, from nearly 46,000 to nearly 42,000 flat. Big $4,000 swing here in Bitcoin. And what happened here on this downside later on in the day was that one of the Fed officials, Bullard, came out and said the following. Let's find the article. I think it's this one. Here we go. And stocks decline steepens on Bullard's rate hike comments. Okay, so this came out yesterday, and the NASDAQ fell, Bitcoin fell. Remember, the short-term people are treating it as risk on asset. Therefore, if they think that there's going to be hawkish activity, which means faster or more aggressive monetary policy, interest rate hikes, people flock out of their growth stocks and they flock out of Bitcoin. Those types of people that invested on that time frame. Now, stocks fell further this afternoon as the Fed, James Bullard, said he'd like to see a rates full percentage point higher by July. Now, remember, we already knew pretty much from what Jerome Powell said a couple of weeks ago at his last update that we're going to see a rate hike, right? He's telegraphed that nice and easily since 2021. His whole approach has been, I don't want the market to be uncertain. Because remember, what happened with the taper tantrum before when we had our first round of QE? The taper tantrum happened in the Bernanke times because of the lack of telegraph. The market didn't know what was going on, therefore it panicked. So Jerome Powell came into this knowing that, having done his homework. He was very clear in all of his updates through 2021. I'll make it very clear when we start tapering. I'll make it very clear when we start tapering. I will make it very clear when we start to talk about tapering. Do you remember that? We covered that here on this channel. And then he's going to do the same with interest rates. He's not going to have done all of that to suddenly change his mind to do an emergency rate hike. He can't risk the interest rate tantrum, the lift-off tantrum that could happen. Okay? So what's going to be really important for him, and we need to understand his stance, is that he needs to do things in a slow and progressive way. And at the moment, the market expects 0.25%. He can even argue, and we're going to come on to why, that the market can expect 0.5%, which is a double rate hike in March. Okay? What he cannot do is the market would not accept anything more than that, really. We're going to come on to that shortly. But what Bullard is saying, he's like to see rates full percentage higher point by July. Now, people are taking this out of turn, like this is suddenly against some of our expectations. A full percentage point by July means one this quarter in March. It could be a 0.5% hike in March and another 0.5% hike in the Q2 meeting. Okay, that gives you your 1%. That wouldn't be completely out of the norm because in March, if we got a double rate hike, I'm going to show you that the market isn't too worried about that. Okay, let's head over into this. It's a really useful tool, guys. If you head over to the Fed rate monitor tool, you can see the next Fed decision. We know the FOMC is on March 16th. It's in 4 weeks, 5 days now. I've said many times we're going to have a lot of volatility and uncertainty leading into this point. But this is what I want to focus on right now. This is what I want to focus on. And right here, you can see that we have a 64% probability that we've priced in rate hikes between 0.5 and 0.75. We've got 35% between 0.25 and 0.5. So markets are really pricing that in quite a lot. Now, just last week, the top bar was only priced in by 25.9%. I just don't know if you can see that there. Okay, 25.9%. That's gone up to 90. That's gone up now to 64% currently. Okay, so the market is not going to be afraid by a 0.5% rate hike. It's already priced in. The market knows about it, and more importantly, if you're a long-term investor, this shouldn't be an issue whatsoever. Because let's remind ourselves of what's happened. What's happened is we were in a situation where it was an unprecedented time. There's a pandemic, and there was a whole bunch of printing done. The printing is now completed. The economy is healthy. It's achieved its objective to all intents and purposes. Now that aid needs to come off. Inflation means everybody's doing fine. We're overheating, right? The tires are burning. Okay, we don't need somebody pushing the car, giving it extra acceleration forward when the tires are already overheating. Just let us cruise along. So increasing interest rates are perfectly fine for doing that, okay? To take off some of that pace, just to bring us back to a normal cruising speed, which is what we need in a healthy economy. Earnings are looking good. The market's fine. We don't need this support. So the fact that the markets are getting worried about this is a bit irrational. It's irrational because we don't need the support, right? We needed the support then because we're in the middle of a pandemic. We're forcing people to stay at home. Now the economy is doing well. Why do you want the extra Red Bull? You're awake. You've had good sleep. Why do you need the additional Red Bull in the economy? You don't, right? So that's a separate irrational point there in terms of why these interest rates are not a big fear. The other thing that people are failing to mention, the guy who spoke, Bullard, is the biggest hawk of them all. Like, this is the article from September 2021. I can bring up countless articles of Bullard. He's now, the way the FOMC meeting works is there are 12 voting members. He's one of them. He doesn't speak for the whole of the Fed. Everybody has their own stance, and he happens to be one of the most hawkish ones. Back then in September, he was talking about tapering sooner, shrinking the balance sheet, bringing up interest rates. This was in September. Right? So obviously he's going to think that now. He has to keep his opinion up. He can't say, oh yeah, what Jerome Powell says in terms of 0.5% base rate, I agree with that. He's naturally more hawkish than the average. Okay? And more proof of that is just take a look at this article published by Bloomberg today, 11th of Feb, updated. Fed doesn't yet favor a half-point hike or an emergency move. So now they're saying the majority of the Fed are not feeling like it makes sense to have a half a point move. And you can go down in the article, have a good read of this article, but the bit I want to bring to your attention is this. San Francisco Fed Mary Daly, so she's she's the Fed San Francisco president, so she's one of the voting members, said Thursday that a half-point rate hike is not my preference. Speaking to Market News, she cited the lingering drag of the pandemic and the fact that the Fed is already sending a clear message on its readiness to act. Okay, so she's saying, look, markets have already priced in the withdrawal of accommodation, and that is them hearing what the Fed is clearly communicating. So it's not an issue, right? We know that each one of these Fed members have a different view. And then if you head to the end of the article, this is very important as well concerning Bullard. Bullard called it a half-point move in March, back in March, okay? A sensible response to a surprise inflationary shock that we got during 2021 that we did not expect, but highlighted that he would defer to Powell. Bullard said that the Fed isn't in that mode of emergency rate hikes, noting that there is little need to surprise markets now given the tightening they are pricing in already. So all of this fear in the markets yesterday, this irrational fear that just fell, and it was only a couple of hours, and again, it's traders doing what traders have to do, because if it was true, that's what we're taught. I know this from when I was on the trading floor at Morgan Stanley. You sell now and you figure it out later, right? You sell now, you debate later, because you don't want to be caught in a position where you don't know how the news is evolving when you're trading on hourly or swing trading during the day, okay? Very important. For long-term holders, you wouldn't have been playing around with your position here. You just sit out and wait. And when the news finally comes out, you go, hang on a second, there's not going to be an emergency meeting. And if there is an emergency meeting, are they really going to suddenly do a 1% rate hike in the middle of Feb, 2 weeks after they've had a meeting? That makes them look silly. It also doesn't make sense with the rational approach that Jerome Powell is taking, in that he's always telegraphed every move. He wants the market to expect everything he's doing. And at the moment, the way he's pitched it, and you can listen to the meeting again, the way he's pitched, he said the labour's strong, he said inflation is high, and there's plenty of room to increase the interest rates. Okay, he's not spoken about shrinking balance sheets yet. He's saying that will come from April onwards. So if he was to shrink balance sheets in March, it'll be a shock to the economy. If he was to interest rates by 1%, it'll be a shock to the economy. An interest rate hike of 0.25% would definitely not be a shock. 0.5 will be accepted, okay. 0.7% for me is that Goldilocks area, where if you increase it by 0.7%, you get a little bit of a shock. But as you can see from the percentage that we've seen here, you're not going to get a massive shock. It'll be 2/3 of unshocked versus 1/3 of shocked, which will move the market a little bit, but it'll be okay. And that's the key. We're going to eventually, as an economy, get to 2% interest rates, and it's going to be okay. The economy is going to continue to grow. Companies are going to continue to do well. And the long-term holders know that. So don't react to the short-term people trading. We know what's going to happen in the long term here. Now, let's wrap this up by having a quick look here in the Bitcoin chart. And you can see in the Bitcoin chart, pretty much, we've come down now here on the hourly to pick up some support from 43,000, okay? Now, 43,000 was where we are back in this triangle period. Eventually, you saw that we broke out of the triangle. We faced a little bit of resistance here, bouncing off this line twice at 45,000, which is naturally a psychological level as well. And then your next resistance is at the 45,500. So we need some efforts to come back here, break through certain support horizontal levels, and then work to the upside. Now, longer term, let's head over to the daily. We're going to see some volatility, guys. Between now and March the 16th, we're going to see some volatility here in the charts. So if you kind of zoom, it's not going to go that far out, but if you wanted to zoom out all the way until March, there we go. So March 16th, let's put a line here if we can. There we go. And we put a nice vertical line there. That's our line for when interest rates will be decided by the FOMC. Now, we also know that on March the 10th, we're going to get a CPI reading. Okay, so let's put a vertical line there as well. This is because if you look here, on March the 10th, we're going to get our February CPI reading. That's going to give us another clue. Just like we got the clue the other day for how interest rates are looking and whether we're going to get a hike, that's going to give us a clue because that comes right before the FOMC meeting, right before the 12 members who vote will discuss it. So they're going to have all this data. They're going to have the reading we had from yesterday. They're going to have the reading for the February reading, and then they're going to sit down and make their decision, okay? So, they don't know what they're going to do yet. They haven't got all the data yet, okay? By then, they'll have some more jobs figures as well. So then our question is, okay, how are we looking here on the daily? And my argument would be, this looks pretty good. This looks pretty textbook in that if you look at it, we've come off a low, we've built our way up, created higher lows, higher highs, higher lows, higher highs, all the way up. In fact, let's go to the 4 hourly to see the granularity here. And then what we've done is we've just come back down to test our ribbon. Okay, big move to the upside, flip bullish, came down, retraced down, tried another move to the upside, got rejected back down to the downside, and now we're just collecting some support from our ribbon to head higher. Now, ideally, let's just see if we can get a bit more zoomed in here to see this. There we go. Now, ideally, this wouldn't have wicked so low, right? This wouldn't have wicked as far down, but we know yesterday was a crazy day given what happened. So we would have maintained our higher low and continued our momentum to the upside. So yes, we're in a bit of a sideways pattern now. We've lost some of the momentum from what we had to the upside, but this is a fine consolidation period. If we look at the stock market as well, as the market's open right now, we can see Nasdaq flat, S&P's flat, Dow is flat. So they're not taking massive hits right now. Yesterday was a down day. We saw that after a bunch of FUD from Bullard and the rest of it after the high CPI reading. But the market's taking it in its stride. Like we said, it's priced in, and the economy is going to understand that. People know that this is priced in, and therefore they're overreacting. So a bunch of nothing burger. Now's the time to be positioning yourselves in the plays which are going to give you the returns to the upside. And if we head over to the weekly, just for completeness, here on Bitcoin, you can see here we're just trying to get back into our ribbon here on the weekly. We're still technically in a retracement winter, whatever you want to call it. And until we close above 47, get a nice weekly close above 47, which might be this week, might be the week after, depending on how we get on. That will then close us above our EMA ribbon, and then we can start thinking about the run back up to all-time highs at 69 and posting a higher high, because the next macro goal is to post a higher high. We need to go on a nice journey, however long it takes, right? However long it takes. It can be a couple of good weeks, couple of bad weeks, it's fine. But as long as we post that higher high above 69, then we're good to go and keep posting those higher highs on Bitcoin. There you have it, guys. Hope you enjoyed this blend between technical and fundamental analysis. Hopefully this clears up a bunch of the FUD that was circulating from people who can't be bothered to do the research, but just press the sell button. Hopefully this gives you some sense around what's going on with the Fed, how does the Fed work, and how will they be thinking about these types of things. They're certainly not going to want to surprise the market with a 1% interest rate hike. And, you know, ultimately, even if they did, a 2% interest rate environment is absolutely fine. It's perfectly healthy. The reality is, it's just because so many years of low interest rates, we've become a little bit complacent. People are used to that Red Bull. They're addicted to that Red Bull, and they just need to chill out and say, we're fine without it. We've had plenty of sleep. We're well rested. The economy's doing well. It's nothing to worry about. Okay. As always, guys, don't forget to support NordVPN. Links in the description. Also head into our free public Discord server. Link in the pinned comment below. Meet like-minded people. Talk about your favorite cryptos. Tag me in any questions. Thanks for watching, guys. I'll see you in the next one.